Hello everybody, welcome back to the channel. Today I'm going to go over a little gold strategy which I like to use on the 1 hour time frame. Basically get sniper entries and you'll be able to obviously maximize your profits trading gold. So I did actually use this week, and it's basically trading liquidity spikes and market manipulations, a lot of people call it. So before we start this video, be sure to go and follow my Instagram. I'll put it on the screen. My post on my trading updates. Although I haven't been uploading on YouTube this week, I've been uploading all on my Instagram stories and Instagram posts. So be sure to go and check that out. There is a link in the description too. And also if you want to join my VIP channel, go and check that out. Just message me on Instagram about that one. Okay, so if we go on the charts now, on gold, on the 1 hour, you'll see that when we were back here at the start of December, we had this bullish push upwards. So if we draw this trend line in, we had this bullish push up. We could draw one at the top as well, but yeah, we have this nice push. So we had a tap of the trend line, another tap here, push up, taps of the top one, back down to this one. And what we had here, you see this big wick. This is actually as you can see, a 75 pip wick, around 75 pips. And what this is doing is basically all the buyers, they're entering in their buys here, their stop losses would be just below obviously the previous low of this candle here. So their stop losses will be around this level. So what they do is they basically wick price into the stop losses of the buyers. So obviously it collects orders, they make all their money, and then people are entering sales in the market and with their stop losses just above this level here, so just above the previous candles. So when the price comes down here and on the lower time frames, price will probably be pushing downwards. So what they do is people start entering short positions, and then obviously price wicks back up and makes a bullish push to the upside again. So they've taken the buyers out and then they've taken the sellers out. So they're making all the money, they're hitting all the stop losses, and people are very confused at what's happening with the price. But if you can actually notice this and what's actually happening, you can actually get sniper entries. So when price is pulling back up, you can enter long positions with your stops just below the wick. So if it does carry on going down, then you can obviously get out of the trade. And as you see, if you did enter this trade here, say you even entered on the open of this candle after it pushed back up, and you closed at the highs here, around this level, you still would have profited around 128 pips. So obviously it's a very nice strategy here. So say we entered here, we had stops just below this wick here, and our take profit was these highs. Now it's a 1 to 1.68 risk to reward. Obviously it's not the greatest, we usually aim for 1 to 2s, but obviously you can, as price starts moving up into profit, you can obviously trade or stop to break even, which I like to do as quick as possible really. So then your entry's covered, and then obviously that trade is risk free, so you can't actually lose anything. And also sometimes move the stop loss into entry, like past your entry, so like a staggered stop. So basically then if price does reverse, you get profit either way. So even if it comes back to your entry, you would usually be taken out at 0 or pretty much break even. But say you put it 20-30 pips in profit, then you'd still get 20-30 pips even if it goes the wrong way, with that stop going into the profit. As you see here, after we had that push, we had a bit of consolidation sideways, and then we had a push up to this level up here. And what price actually did was this wick here. We had a wick up, so there were people who were buying when this was a bullish candle, and obviously they got stopped out when it came back down, and then price pushed up again, pushed up above the highs of, as you see, we had the highs here, and price rejected it here, came down, rejected it here, it started pushing above, so people obviously starting to buy, and they were obviously entering buys after we pushed above this level. Price came back down, wicked down, so it would have stopped them out. People were entering short positions now after the rejection of this level here again. And then we had another push up to stop the sellers out, obviously because they would have their stop losses just above the previous highs. So we were stopping the sellers out here, stopping the buyers out down this level here, and then we did have a push down. So you just need to be careful with your stop loss placement of this as well, so you don't want to get wicked out, obviously the wrong direction. But as you see, we had the same here. We had a wick into this support area which we've had previously, bearish candle into this level, push up. We had pushes down, not quite to this level, and then we held this resistance up here, and then we had wicks into this support, back up. So even if you entered a buy off this support, obviously with lower time frame confirmations. So as you see here, we had another wick down into this area once we did actually close below the support. So people were selling here, and we price were wicked up above the support, which obviously was now a resistance. So it was stopping the sellers out here, and people were entering long positions. And as you see, price pulled up and then pushed back down. The long positions, the buyers, were then stopped out again down here, and then price started to push up. So you need to be aware of these wicks, which will obviously stop you out. So yeah, what you got to do is you just got to be careful with these wicks, and obviously wait for candle closure before you actually enter a position. Because say you saw price break this support here, but obviously we haven't had a closure on a higher time frame below this level, then I wouldn't advise obviously entering a position on this trade, because you just need that confirmation, and 3 to 4 compliments usually per trade is what I use. And I'll show you a trade I entered on gold actually in this pair. So we had this nice uptrend, but we did actually have a wick right down here, and this was a very, very large wick. So from the open, it was pretty much 110 pip wick down to the downside into this mini support area, which we had out before as resistance. Obviously we rejected it here, broke, retested it, and then we came back up above this level, and then we obviously wicked into it below this ascending channel. So if we draw this on, we have this ascending channel forming. So yeah, we had that channel, we're wicked down, and on this level here, when price came above the previous high of this candle and on a lower time frame, price was actually rejecting this downside area and was becoming bullish. So we did actually enter a long position on this level just below the open of this candle, and we targeted I think around 1881. So if we put this on here now, our risk to reward, if we go down to our entry, we put this on, so our stop loss was just below these lows here, because obviously if we close below the lows, then we want to be out of the trade. So this was after the wick, so the wick had already happened, it came up, then I entered, and we were targeting 1881, that sort of area. So we had a nice 1 to 4 risk to reward. We did actually break this channel and this area here, which was a previous high, and retested it, so we pushed back up again. About 260 pips on this trade. Lovely, lovely trade. Just trading around this market manipulation here, the liquidity spikes. Obviously we could have held it a bit longer, and price is still currently trading around this sort of area. As you see, gold actually wicked into 1896. So we will be looking for price to maybe break this area and come up to 1900s again, and maybe even break that and obviously push up to the 2000s again, which would be lovely. We can enter some long positions, hold them to 2000, 2100, you know, and yeah, we'll be loving life. But yeah, obviously this strategy, only use it if it does give you multiple confluences. So as you see here, when we entered this trade, we had, as you see, this bearish candle here closed above the support, so we knew the price couldn't obviously close below the support. And when we had this push up, we actually entered the buy position. I'll pop a screenshot here of the actual trade so you can see that I did actually enter this trade. And then as you see, price just rallied up to the upside, 200 plus pips, 260 plus pips to our take profit. If we look on some other pairs for this same thing happening, if we go on GBP AUD, you can see here, you can see that price has done this around this area as well. So what we have is a nice push up, So we have this ascending channel also on the bottom as well, and then price obviously wicks above it. So people are either entering shorts off this trade here, opportunity here, and then obviously getting stopped out from this wick. So obviously people getting stopped out and then they enter long positions, because obviously if they still get stopped out, people are thinking the price is going to go long or push up even more. So they're entering longs here around this level, or even up here. They're getting stopped out, and then price carries on upwards. But yeah, I hope this video did help you understand a bit more about the markets and how to identify certain areas and what is actually a wick and what is a liquidity wick or a market, or when the market is filling orders. So we are actually looking on GA here for another trade opportunity. Yeah, we'll see if price can break the support here, then we'll look for shorts on GA. So obviously we'll see what happens on that one. But yeah, make sure to follow my Instagram, and I'll see you in the next video.